So the specialty that we've seen a lot of activity in is cardiology. So it would be great to get some commentary on that market from our provider services team and the business valuation team.
Yeah, great. Thanks, Zach. I can start off on this one, provide kind of an overview of what we're seeing, and then maybe the BGL team can get into a little bit more specifics on their dealings with their clients and that they've assisted from a transaction perspective. But yeah, cardiology market, that has certainly heated up here, in particular over the last, call it half a decade or so. If we think overall about sort of PE migration, and this is more broadly, not just, cardiology focus, but the PE migration has sort of transitioned from low acuity up to high acuity, as groups have gotten more comfortable as within the healthcare provider space. And so, whereas you start off 10, 15 years ago, involvement was more on the dental, derm, some GI, things like that. Then you've moved into the complete other side of the spectrum, realistically, as you get into things like cardiology, like oncology, that are complex, that are more capital intensive. So the challenges as far as PE moving into that just has caused a little bit of a delay in the PE involvement in that space. And really what you've seen is the most recent increase in attractiveness of the sub-vertical here. Really, you've seen acceleration of that when some of these traditional hospital-based cath lab procedures and in-office cath lab procedures have moved into potential ASC settings. And so we talked about it some with MSK as well. But when you're talking about cardiology, you've seen a significant number of procedures that have moved from, the inpatient only list, then been taken off the inpatient only list, and then being put on the ASC list as well. And so I think the interesting part about that, though, is you have perhaps a larger number of buyers when you're looking at cardiology practices. Not only do you have these platform entities that most of which are PE backed, but you also have what we've seen most recently is a lot of our health system and hospital clients are getting into the mix here too. They're concerned about, as these procedures have moved into the outpatient setting, that they're going to be kind of left holding the bag and not, have any involvement with what was previously groups that were very, very important and key to their surgical volume, their inpatient volume at their hospital, and ultimately their revenue generation and profitability. So cardiologists as a whole, they've got a long history of both hospital employment and being independent. We saw 10, 15 years ago, you had a huge wave of cardiologists being employed by hospitals. That, like a lot of subspecialties, hospitals would lose a fair amount of money with those large, on the professional side, with those large groups, those cardiology specialty groups. And so then many moved into their own groups and hung their own shingle there separately from the hospital. And now we're seeing a wave back, again, started with these PE-backed platforms, and now hospitals certainly coming into the mix as well, as trying to figure out how they can potentially align with these cardiologists as they're seeking potential affiliation, like a lot of groups are, as it becomes more challenging to operate independently going forward. So again, I think we're seeing within cardiology a lot of activity. I think we'll continue to see a lot of activity over the next couple of years. But certainly interested in the BGL team's thoughts specifically on their dealings with their clients.
Yeah, Kevin, thanks. I think to echo a lot of what you were saying, we've seen cardiology really catch fire with respect to private equity, sponsor involvement and interest. Over the last 2 years or so, 10 platforms have formed up, and it's been really a land grab ever since to get as much scale and as many cardiologists up under these platforms as possible. And so the volume has been high. The constraint, to your point, is supply of available physician groups, right? 70 to 80% of cardiologists in this country are employed by health systems today. And so what's available to buy if you're a private equity sort of roll-up strategy really is the balance. And then I think to your point, hospitals are getting quite concerned about the outmigration of volume, and how do they stop that, or how do they participate in that, right? And so you're seeing, at least in certain markets, health systems actually interacting and partnering with some of these private equity strategies to say, look, we understand that this volume is leaving the hospital. We understand that these doctors may even want to, reestablish private practice employment, or come up under employment of one of these private equity strategies. And we could be okay with that, especially because as hospitals, we maybe weren't necessarily ever intending to be employers of doctors, but rather, a hosting facility for surgeries. And they're saying, okay, so how can we participate in this shift? And I think what you'll see is a lot of joint ventures on surgery centers, as well as other potentially creative partnerships with what will be the new professional group employers, the private equity roll-ups, versus what has historically been a largely hospital employed specialty. I think it presents well for the investor community, both on the real estate side as well as the corporate side, in that a lot of what's driving the shift and what drove the shift over the last 2 years, and the big private equity push into cardiology, is what you mentioned, procedures coming off the inpatient only list onto the ASC list. In particular, the big sort of turning point, as it's considered in the industry, was the allowance of PCI or stenting in the ASC. That was where everybody sort of tuned in and said, okay, this shift is real. We got some real procedure volume that's going to move into the ASC. You also think about the electrophysiologists who, if they don't have an ASC in their private practice today, they can't really do anything or participate in any sort of technical revenue streams. And then you mentioned, cath labs or OBLs. There's some things happening in the reimbursement environment there, which are making some of those procedures potentially make more sense in the ASC, which is a little bit of a more highly regulated setting with better quality outcomes. And then you think about, okay, how are we going to build that ASC, both from an operating standpoint as well as a real estate standpoint? There's investment that needs to go there. So Clint mentioned earlier in orthopedics that cardiology was a close second in terms of the need for dollars to invest in the right infrastructure to make cardiology make sense in the outpatient environment, right? I think in GI, there's something like 1,000 GI specific ASCs in this country. In cardiology, I don't even believe we've hit 100 yet. And as you can imagine, cardiology doesn't make a ton of sense in like a multi-specialty ASC, because you'll have freeloader issues and things like that. Whereas the trend towards single specialty ASCs is especially prevalent in cardiology, and so you'll need someone to invest in all of that infrastructure, which will have downstream benefits like value-based care and things like that once we have all the right infrastructure in all the right markets. And then from an operating perspective, on top of things like working capital and getting these things set up and investing in new physician guarantees and things like that, there's actual equipment and new technologies and these ancillary investments that physicians can make, but they're not cheap. Things like PET CT, things like sleep medicine and sleep labs, even looking at some of the preventive measures like RPM or CCM, right? There's any number of new ancillary opportunities within the specialty that all require investment and are becoming or driving the interest from the PE sponsor community. So I think all of these things are culminating in what has been a feeding frenzy for any and every available cardiology asset, coming and tucking up under what I believe is plus or minus 10 platforms today, with another, call it 10 to 20 private equity firms looking for a way to establish a platform. In fact, that we've seen that the appetite is so high for a starting point in cardiology, right? Because so many of these physicians went up under hospital employment that there's just a lack of sizable call it platform investments, right? So, traditionally a private equity firm might look for a starting point at plus or minus 10 million of EBITDA. That just doesn't exist in cardiology, across the country, and certainly not anymore, as a lot of these groups have been gobbled up. And so you're seeing these private equity firms really dip down low, and maybe they're starting with one or two or three sort of 2 to 3 doctor, what I'll call tiny groups, in a market where they might have a cluster or some scale, or they're friendly with one another, or they can say, okay, look, we can get a management team, we'll fund some working capital, we'll acquire, at a much smaller level than we otherwise would, just because we got to get a piece of this cardiology pie. So it's been an interesting market, at least from our perspective, in terms of activity and interest and valuation. Quite frankly, valuation in cardiology is one of those specialties that has been, bucking the trend, or frankly just disregarding what's going on in the broader market. So it's been active. I think I'd like to plug VMG. They helped us out on the QOV side, Southside QOV, for a big cardiology deal we did last year, and they did a great job. So I'll plug you guys there.
Yeah, thank you all, and I appreciate that commentary on the corporate side. As we think about the real estate aspect of independent cardiology practices or outpatient cardiology facilities, I think a lot of that is fairly a recent development, as John Tyman had alluded to. We've seen historically physicians, cardiologists, be largely tied to the hospital facility. Historically cath labs have been in the hospital, so doing a lot of the higher dollar procedures there. As we've seen, I think, coinciding with perhaps the expiration of some employment contracts for physicians with some of the larger systems or hospitals, and they think, okay, now perhaps we want to go back into private practice, form a group within their local market, and move some of these procedures out of the hospital as the inpatient only list has started to peel off and these procedures have been put onto the ASC approved list. Now you're looking at having to invest real dollars into these outpatient facilities, be that in the ASC or even in an office setting. But from an investor perspective, and on the real estate side, this is actually a fairly attractive proposition, for a number of reasons. One, this drives a much more profitable underlying business, or the tenants within those properties is going to be a lot more profitable and have a lot higher debt coverage, so ability to pay their rent with a lower risk of default, which is obviously very important. But in addition, a lot of the specialization that's required for these facilities, right? So as John had alluded to, investing in a number of different new technologies, many of which are really kind of come part and parcel with the facility, so require some significant tenant improvements. That's going to drive some stickiness as well, right? So it's very unlikely that you see a cardiology practice or number of practices invest in an ASC and then go and start to drive procedures there for a couple years, and then perhaps now they look to move back and partner with the hospital system again. Unlikely that they're going to abandon that space in any way, and that space is going to be utilized for those procedures going forward. And so I think there's a stickiness there as well that is attractive to the investor community, because they know that's going to support a long-term stream of cash flows that they can rely on pretty consistently. Victor, happy to turn that over to you if you want to add any other perspective as relates to cardiology.
Yeah, on the cardiology front, to kind of piggyback on your comment, Sean, one of the things that I've seen is a repurposing of some other real estate space to cardiology use, and I'm thinking of a couple of examples of former big box retail stores projects that I've worked on, where a large cardiology group has turned those into space with cath labs and other kind of higher end build out, which serves as an example of a couple of different macro trends intersecting, softness in the retail sector, availability of existing commercial space combined with demand more broadly in the medical space, this continuing to pound the drum of outpatient migration and these procedures being performed outside of the hospital setting. I think I remember a statistic of half of all cardiology procedures are projected to be performed outpatient by the end of this decade. So that's obviously driving demand to the real estate side. On the flip side, it is a space where you'll see some uneven distribution of coverage. Cardiology practices being acquired by a larger entity, and sometimes those acquisitions having overlapping and competing territory, and yet maybe having a white space or lack of coverage nearby. So when you're looking at a market and thinking about cardiology services, that's certainly a factor from a real estate perspective that informs risk of, to your point, Sean, of default or of honoring a lease liability. But otherwise, I think you all have covered it. A lot of analogs to the ortho space: high growth, high demand, high cost facilities. Certainly a strong subsector when it comes to the healthcare real estate markets.